Last week, the Bank of Canada hiked rates by 0.25%, the first of what is likely to be a series of hikes expected to take us up to almost 2.5% by this time next year if Bay Street expectations are correct. But is there a possibility that we could go even higher? And what are the macros that we should watch for? With me to discuss this is WisdomTree asset allocation strategist Jeff Weniger. Jeff, thanks so much for being with us today.
Ruth, great to be here.
The governor has indicated that the Canadian economy is almost at capacity. What does this mean for interest rates and inflation both?
Well, I think it was the part about the capacity that Stephen Powell has mentioned in the release by the Bank of Canada that would give you the, I would say, the courage or the encouragement to anticipate that if Bay Street is calling for 2.5 from 175 now, so 3 more hikes between now and December of 19, it would be basically the almost cheerleading of the economy from the central bank, where it's identifying a full capacity economy, which is corroborated by the U.S. data. That capacity utilization in the U.S. is down, near 80, so very, very high, very, very late cycle. The type of environment in which, if you're looking at 250 or even upwards of 275 on the short end of the Canadian yield curve, it's not outlandish to make such a prognostication.
You mentioned that real estate sales are a key thing that we should be watching for, and now with home prices going into the unaffordable territory for many, especially in Vancouver, how do you think this is going to tie into the rates and inflation?
Yeah, I mean, if you think about it, 2019 will be upon us before you can blink, and if it's correct that we will be seeing 2, 3, 4 hikes, that would be basically the entirety of the bell curve for what the Bank of Canada can do. Mortgage resets are going to, every day somebody else gets reset on their mortgage, and you have to start thinking about, okay, you mentioned Vancouver, you also have Greater Toronto as well, which has been doing that sideways, gentle price slowdown here for 5 or 6 quarters, probably the best case scenario thus far. But I think you have to start to question at some point, if there is a pinch when you have 2 bordering economies, both aggressively tightening monetary policy, and if there is a pinch, that people start to feel it in their auto loans, start to feel it in their home equity lines, and perhaps it starts becoming an issue on housing prices, I think you have to start thinking about whether or not leadership within the market, this what we call it 10, a dozen years of the big 5 banks dominating TSX comp, these types of indexes, start thinking about index construction. This has been the story for Canada for so many years, energy, materials, and financials. Start thinking about some of the ways, for example, the way that WisdomTree has done it, where we have broad Canada, but with less of an emphasis on the big banks, if you think that that's an issue. If not, then maybe another index might be more appropriate. But just think about what are the second and third tier effects from tightening monetary policy, and reorder your portfolio accordingly.
And one of the last things I want to ask you about is how you are looking at the global banks at this point. The Fed and the Bank of Canada seem to be raising rates, but the ECB and the Bank of England seem to be a little, cooling off as far as that's concerned. So how are you reading the global situation right now?
Yeah, and that's one of the key things that WisdomTree has been writing about, that I've been writing about, that my colleagues have been writing about essentially for the last 6 or 12 months, is that you mentioned the Bank of England. Brexit is a March 2019 deadline. Is it going to be a hard Brexit or a soft Brexit? Nobody knows. You don't know. I don't know. European Central Bank has kind of a double-edged sword in that it has to consider the Italian banking system's exposures to 2 factors. One, the Turkish debt, which that hasn't gone away. It's just there's been so many headlines that it's falling down the headline list. And then also the cost of writing down the Italian sovereign bonds, which have been selling off. So you have central banks that are, at this point, called a year from now, you could be 200-300 basis points south of the Bank of Canada in some of these other currencies, mainly the ones that you mentioned, euro and sterling. And so that's why it's imperative to either think about doing some sort of variable hedge strategy like we have over at WisdomTree, or an outright full-on hedge. European equities, hedge the whole gamut back to CAD.
Right. Thank you so much for joining us with your perspective, Jeff.
Sure, Ruth. Absolutely.
For Morningstar, I'm Ruth Saldana.